given this mass liquidation, which I think looks like it was liquidity driven. I think people are getting some margin calls. I think there's some forced selling. And that may have been why the gold stocks got hit so hard yesterday. Even though gold was not down very much, maybe less than $20, gold stocks were down 4% or so. In fact, that's how much they were down on the week about. The GDXJ were off about 4%, pretty much all those losses being clocked yesterday. In fact, we made up some of those losses today. So actually it was a bigger drop, or there were some losses earlier in the week. Silver was down over $1.50 in the early morning hours, got below the $50 level, came back up to about $50 late in the day. In fact, it did trade back above 50 intraday, but it looks like it's settled just below 50. I mean, I'm not sure the exact settlement yet because I'm recording this this pretty soon after the close, so I'm not sure where the settle is. But right now I'm looking at about a dime below 50, 49.90. But again, holding near $50, that's the breakout level. That's the old double top. So gold and silver holding up very well in the face of all of this market volatility. Part of it, though, is coming out of Japan. Part of the liquidity squeeze, the yen carry trade. The new Japanese government announced a massive new fiscal stimulus where they're going to be mailing out stimulus checks and doing some other stuff, right? And, these stimulus plans are all misguided. They've been making lots of mistakes in Japan, just like we make mistakes here. Although the Japanese stock market has been doing great, although all the other stock markets got clobbered last night as a result of this and what's been happening to Japanese government bonds. In fact, the 10-year JGB, the yield got above 1.8% yesterday. It backed off a bit today. I think we settled at about 1.77, but 1.8 was like a 20-year high. I forget exactly, but I've been talking on my main podcast at the Peter Schiff, not on so much on the Schiff Gold, although I probably mentioned it, but I've talked a lot about the yen carry trade and the blow up of the Japanese government bond market. And that's what's going on, because when this started, the yield on 10-year Japanese government bonds was less than 50 basis points. And I remember when, they had a line in the sand there, they were trying to hold the yields below 50 basis points. In fact, they were quite a bit below at one point. And now they're more than triple that. I think once we get above 2% in the 10-year Japanese government bonds, you're going to see, some real fireworks in the markets, not just in Japan, but all around the world. But it was interesting because the government came out and said that even though they're doing this massive stimulus, they don't anticipate increasing the issuance of, Japanese government bonds. Well, how can that be, right? How are they going to run bigger deficits and not have to issue more bonds to finance them? And what I'm thinking could be the situation, and I don't know because the Japanese have been a bit reluctant to do this, but it's the smart move. Maybe instead of selling Japanese government bonds, issuing new ones, they'll sell some U.S. treasuries because they've got over $1 trillion, right? Losing value. The best way the Japanese can stimulate their economy is by selling treasuries, not JGBs. See, because if they run bigger deficits, that's going to spook the bond market even more. That's going to weaken the yen. That's going to push up import prices. It's bad news. And the yen is already weak, near 160 against the dollar. They can solve their problems by selling treasuries and then selling the dollars they get when they sell treasuries to buy yen. And then they can send out that yen to Japanese citizens. And that's great because that'll strengthen the yen, which will give the Japanese more purchasing power, which will help bring down their import prices. And so that's the best way to stimulate the economy without hurting the economy. Because if they stimulate it by selling more Japanese government bonds, then you're going to weaken the yen. You're going to have more inflation. You're going to have more upward pressure on yields. So selling treasuries is great for Japan, but it's going to torpedo the U.S. economy and the U.S. financial markets because selling treasuries pushes up our yields. Right? And it pushes down the dollar. And it also causes an unraveling, more so, of the yen carry trade, where people who borrowed yen to buy risk assets in the U.S. or even treasuries, now have to reverse those trades, sell out their risk assets to buy back their yen. So some of that pressure may already be what was coming down on the U.S. tech stocks, and we'll see what happens next week as we continue and build on what happened this week, which again was a very significant week in the markets. But one of the reasons I think it was very significant for gold too is the blow up of Bitcoin, right? And because Bitcoin has been overshadowing gold for years, right? It's been stealing all the headlines, stealing all of gold's thunder. And I know it's been very frustrating to the gold bugs to just watch all the crypto bugs getting rich while, gold was going sideways. And in fact, it was, the years of sideways action. Gold peaked out from its big run from sub 300 in 1999 to 1900 in 2011. From 2011 to 2014, gold really didn't go anywhere because it didn't get above 2000 until 2014. And that was about the peak from 2011. So it was during that dozen-year time period where gold holders were frustrated by the failure of gold to make any new gains, that Bitcoin was able to really steal the show by convincing a lot of people that it was the new gold. After all, look at this spectacular appreciation. Bitcoin keeps going up. Gold doesn't go anywhere, right? So Bitcoin is taking gold's place. It's better than gold. It's gold 2.0. And the markets kept, reinforcing this up until this year.
Look, what happened this week should be a wake-up call for anyone who still believes the Federal Reserve has everything under control. Anyone who thinks markets are stable, that liquidity is abundant, or that these asset prices are real. Because what we just saw wasn't normal volatility. This was the plumbing system of the global financial architecture shaking violently. The kind of shudder that comes right before a pipe explodes. And when pipes explode in finance, you don't just get wet, you drown. Now, I know Wall Street headlines tried to spin it as profit-taking, or rotation, or tech-led rebalancing. No, this was forced liquidation. Margin calls across multiple asset classes firing like a machine gun. You saw it in tech stocks, in crypto, in leveraged ETFs, even in precious metal miners. Traders didn't sell gold stocks because they lost faith in gold. They sold gold stocks because they needed cash, fast, to plug holes somewhere else. And that's exactly the kind of environment gold thrives in, not because gold rallies instantly, but because these liquidity crises expose the real fragility of the system. And when fragility becomes visible, confidence starts to evaporate, and that's when people rush back to actual money. But let's start with the data. Gold was down maybe $20 at one point, basically a rounding error. Silver dipped under $50 briefly, bounced, got back above $50 intraday, and closed just under it. And yes, $50, for anyone who remembers the Hunt brothers, for anyone who remembers the 2011 spike, isn't just another price level. It's the mother of all resistance points, the classic double top. And silver is holding right below it, refusing to break down even in the face of mass liquidation. That's not weakness. That is coiled strength. Now, meanwhile, the mining stocks, GDX, GDXJ, took a 4% beating, almost entirely because traders were dumping anything liquid to meet margin calls. Anyone who's traded long enough knows that miners always behave like this at turning points. They get slammed hardest in forced liquidation days right before massive upside moves because they're the most liquid source of cash for stressed traders. So if anything, this behavior is classic late-stage capitulation. One of those signals that, a few months later, people look back at and say, oh right, that was the last disguise before the breakout. But let's talk about the real earthquake underneath this. The yen carry unwind and the Japanese bond market blowing up. The Japanese government just announced yet another massive fiscal stimulus. Checks, subsidies, more government spending they can't afford. Exactly the same stupidity we see in the US, Europe, Canada. Politicians everywhere think you stimulate an economy by printing more money. It's financial vandalism disguised as policy. The problem is that Japan has been lying to the global markets for decades through artificially suppressed yields on Japanese government bonds, JGBS. They said inflation didn't exist. They said yields didn't need to rise. They said they could print forever without consequence. And now the JGB market is puking. 10-year yields spiked to 1.8%, the highest in decades, and the calm veneer finally cracked. Because once those yields break above 2%, you don't just have a Japan problem, you have a world problem. Why? Because the yen carry trade is massive. Trillions have been borrowed cheaply in yen and plowed into US tech stocks, US treasuries, crypto, emerging markets, you name it. When Japanese yields rise, those trades unwind. People must sell the assets they bought with borrowed yen and buy yen back to close the trade. That's exactly what we saw. Forced selling everywhere. Now let's address the part nobody's talking about. Japan says it won't issue additional JGBs to pay for this new stimulus. Really? Then what are they going to issue? Magic beans? Air? Wishes? No, here's how they do it. They sell US treasuries. Japan owns over $1 trillion worth of them. Selling those treasuries gives them dollars, which they then convert to yen to finance stimulus checks. That strengthens the yen, lowers import costs, and helps Japanese citizens. It's actually smart policy for Japan.
So I think in 2026, you're going to see a lot of people that are going to be trying to rotate out of crypto into gold. Of course, there's not going to be much to rotate out of because the market's going to implode. So most of the money is just going to disappear, right? It went into the pockets of the people who sold the Bitcoin. They've been selling Bitcoin for years. The old OGs and the whales who got in at much lower prices years ago. They're the ones that benefited from the big run up, not the people who have been buying it recently. But also, I think a lot of the institutional money that didn't even buy Bitcoin, one of the reasons they didn't get into the gold market was because they were hearing all this hype about how Bitcoin is going to replace gold. It's the new gold. And they probably thought, well, why should I buy gold? I mean, it's going to be replaced by Bitcoin. So even if they weren't buying Bitcoin, all of the Bitcoin hype may have discouraged them from buying gold. But gold is going to emerge as the winner. You know, it's slow and steady wins the race, right? The tortoise versus the hare. Gold is going to emerge triumphant from 2025 with this huge performance as you know, the air is coming out of the Bitcoin and the crypto bubble. I really think that there's only one hope that Bitcoiners have to stop this implosion, and that's a government bailout. U.S. government bailout of Bitcoin. Now, of course, they wouldn't frame it that way. What they might do is Trump might come out and say, because of this big drop in Bitcoin, we're going to buy the dip. We're going to use this opportunity to fill up the strategic Bitcoin reserve, right? If the Bitcoin, lobby that bought and paid for the Trump campaign, if they can convince Donald Trump to buy this dip on behalf of taxpayers, right, which he's really just screwing the taxpayers over. But if the U.S. government, goes into the market and doesn't just buy Bitcoin, but indicates that it's going to buy a lot more, right, to get people excited about front-running the trade. Absent that, I just think it's a one-way ticket down, and that's going to be great for gold. Of course, if the government has to bail out Bitcoin by using this strategic Bitcoin reserve, that proves that the whole concept is nonsense. Because if Bitcoin needs a bailout, then clearly it's not a reserve asset, right? If the government has to come to the rescue of Bitcoin, then how is Bitcoin going to rescue the government? Because that's the whole point of having all this Bitcoin. It's supposed to save us. We're supposed to make all this money on this Bitcoin. But if we have to prop it up and prevent it from collapsing, it reveals the truth. So it's pretty hard to try to put lipstick on this pig and spin it as a good move for America to have a reserve of Bitcoin. But again, that's the only thing that I can see, because a lot of the Bitcoiners think, look, this is no big deal. Bitcoin always drops and it always comes back, right? So we don't have to worry. We'll just hodl, right? We'll hold on for dear life. We'll ride it out and it's going to make a new high, just like it always does. And of course, people have been conditioned to believe that, right? And it's going to work until it doesn't. And I know you're not supposed to say this time it's different, but this time it is different, I think. I think the leverage is much bigger than we've had in the past. We didn't have all these ETFs that I think you're going to see unloading. We didn't have them in prior cycles.
The truth that nobody on CNBC or Bloomberg wants to admit, and frankly, many of them don't even understand, is that the reason gold is rising isn't because gold is changing. It's because everything else is breaking. You don't measure gold in dollars, you measure dollars in gold. And this week, the dollar lost ground once again. People look at the gold chart upside down. When gold goes up, that's not gold getting more valuable. That's the dollar getting weaker. The problem is that the public has been trained backwards. They think these fiat currencies are the rulers, but they're not rulers, they're the variables. Gold is the constant. And this week was one of those rare moments when the curtain lifts and people catch a glimpse of the fact that the entire global financial system is one giant margin call waiting to happen. You had people in the tech sector getting absolutely annihilated. Nvidia, Wall Street's new temple of worship, fell apart post-earnings. Bitcoin melted down. Risk assets tanked. And what happened? Everyone who normally lectures me on how gold is boring suddenly remembered that boring is good when everything else is on fire. But let me connect the dots on something that most people haven't fully appreciated yet. The yen carry trade isn't a little side issue, it's the earthquake underneath the house. The Japanese government bond market is the second largest in the world. When yields move even 10 basis points, it impacts trillions of dollars of leverage. Japan's entire financial architecture was built around one assumption: yields would stay near zero forever. That assumption is dead. Once yields break decisively above 2%, which looks almost inevitable at this point, you are looking at a global reset in risk pricing. Japanese pension funds own U.S. treasuries, U.S. corporate bonds, emerging market bonds, Wall Street equities. Basically, every asset bubble we've inflated over the past 2 decades has Japanese leverage under it. And now that leverage is starting to unwind. And you know what the mainstream headlines say? Liquidity event triggered by BOJ miscommunication. Miscommunication? This isn't miscommunication. This is math. You can manipulate markets for a long time, but not forever. And what's Japan's brilliant plan to handle its deficits? Sell treasuries. Of course they will. They'd be insane not to. Selling treasuries strengthens the yen and lowers import costs for Japan, helping their consumers. But it destroys the U.S. Treasury market because we rely on foreign buyers to subsidize our deficits. So the very thing that is good for Japan is lethal for America. Another point that didn't get nearly enough attention. When the Japanese announced the new stimulus, Japanese government bond yields didn't just rise, they spiked violently. That means bond investors are finally saying enough. They're no longer willing to pretend that endless deficits can be financed at artificially low yields. And as soon as JGB yields rise, global traders start unwinding yen carry trades, which means margin calls across global markets. And when you combine that with a Fed that is trapped, unable to cut, unable to raise, you have the perfect storm. And here's where it gets even worse. The banking system is again showing signs of stress. The secured overnight financing rate, the SOFR, keeps drifting above the Fed's upper target range. That's not supposed to happen. That means banks don't trust each other enough to lend at the Fed-approved rate. Sound familiar? It should. This is exactly what happened in 2019 before the repo crisis. And now repo usage is creeping up again. Not because banks want cheap money from the Fed, but because they have no choice. Bloomberg even reported that John Williams from the New York Fed had an emergency sideline meeting with major banks asking them why they weren't using the repo facility more. And the banks basically said, if we go to the Fed for cash, it signals weakness and makes us look like we're in trouble. That's the same reason banks avoided the discount window in 2007, because going to the central bank is a scarlet letter. It's the equivalent of telling the world you're underwater. And remember something important. When the Fed has to step in with repos, that means the system is already out of cash. The liquidity has dried up. There is no margin left. This is the exact precursor to financial events that look sudden, but are actually inevitable. Look at Silicon Valley Bank. One day it was fine. The next day it didn't exist. Nothing in between. These events don't happen gradually. They happen when one domino falls, which knocks down the next one, until the whole line collapses. The reason we see these violent market whipsaws is because the system is at a fork. The Fed can choose to let deflation happen, which means allowing asset prices to collapse, loans to default, banks to fail, and credit to contract. Or the Fed can choose inflation, which means printing so much money to stop deflation that the value of the dollar implodes. In one path, markets crash. In the other, the currency crashes. And make no mistake, they will always choose to save the banks and the government. They will always choose inflation. They will never tolerate deflation because deflation destroys debtors, and the biggest debtor in the world is the US government. And people ask, what will the gold price be in that scenario? That's the wrong question. The real question is, what dollar price will physical holders stop accepting? At what point do people say, I'm not giving you my gold for your depreciating liabilities? Because that's the real endgame. When the market refuses to trade real money for fake money. When the transition happens from currency back to money. And I'll tell you something else. Long before gold stops trading for dollars, the mining stocks will explode higher. Because these companies are effectively leveraged claims on real money in a world drowning in fake money. And right now they're priced like money doesn't matter. They're priced as if fiat currencies will remain valuable forever. That fantasy is coming to an end. Bitcoin's collapse this week is also significant for the psychological shift it triggered. For a decade, Bitcoin was marketed as digital gold. But digital gold doesn't melt down during liquidity stress. Actual gold doesn't need liquidity inflows to stay alive. Bitcoin does. The fact that Bitcoin cratered exactly when it was supposed to shine shows you everything you need to know. It's a speculative tech asset, not a monetary asset. Anyone who still believes otherwise is denying reality. And here's the part the mainstream still doesn't get. Gold didn't rally this week because people suddenly love gold. Gold rallied because the system is deteriorating. When a building catches fire, you don't run toward the flames, you run toward the exits. Gold is the exit.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.